Welcome back, everybody. It is Tuesday night, and this is Vetted VA Live after a week off for celebrating the 4th of July and our nation's wonderful independence, which so many of you fought to keep us free through the years. We're back this week with another topic, an important one. Some misconceptions in here, some misunderstandings. Obviously, with the VA loan program, you don't have to come up with a down payment, but there are some funds that you do need to have at closing and be prepared to come up with. So, what we're going to be talking today is closing costs. We're going to go through prepaids and the total cash to close that you need to have at closing. This week, we don't have any of our real estate partners with us, any of the vetted realtors. We have two loan experts from opposite sides of the country, almost exact opposite sides of the country. We've got Jessica Wells from Olympia, Washington, and Mike Alberico from Raleigh, North Carolina. You guys might be almost, Mike, if you were further down in Florida, you guys would be as completely far away from each other as you could possibly be. So we've got three of the four corners of the country covered. I'm here in Southern California. For the most part, closing costs are going to be pretty consistent through the country. There's some regional variations. We'll try and touch on that as much as possible. But remember, our most important purpose here is to get your questions answered live, much like you can go out in the group and post your questions and get text answers and even sometimes video answers. But here we have an open forum. If you have a question, if it's related to closing costs, cash to close, anything mortgage or real estate related, VA or not, we're here and we're happy to answer that. So just throw your questions up in the comments and we'll be happy to get to them. But with that, why don't we jump in? And I kind of like to start this discussion at the beginning with cash to close, and then we're going to go through and break down what that is. So, Mike, sometimes we will get veterans that are surprised to find out that with a zero down loan, there can still be funds that you bring in at closing or even at the beginning of the process with your deposit. Why don't you walk us through what cash to close is and kind of what it is made up of, what things you will be looking to pay if you're not, even if you're not making a down payment?
Yeah, absolutely. So early on in the process, when you're getting pre-approved, you'll probably see like an initial fees worksheet or a cost breakdown. That's going to have all the estimate fees on there involved in the transaction. And then once you're under contract and you go to lock a rate in, even if you choose not to lock a rate in, which right now probably isn't the wisest choice because of the volatility in the market, you'll get your official loan estimate. And the great thing about the loan estimate is it breaks down all the costs and tallies them up on the bottom. And they're actually broken down into different boxes so that you can know what the differences are between lender fees, services that you can't shop for, such as like a credit report. Dealing with a VA loan, we order the appraisal through the VA portal, and that's also set by the VA. And then you also see a box below that. And like you were saying, most of those costs in box A and B will be pretty close to the same around the country. But when you get to box C, which is services you can shop for, those are going to be your title, attorney, different fees associated. And those are going to vary regionally based off what's needed in the state. Some states require a survey. Some have higher title fees and different title searches. And then on the right side of the page is when you get into your prepaid items. Now, the prepaids are broken out differently than closing costs, but they are still cost to close. They are money out of your pocket, and that's going to consist of three main categories. Your government fees, which are to record the deed and the mortgage. Some states charge transfer taxes to the seller, some due to the buyer. And then you'll have your true prepaid items for taxes and insurance, and if applicable, HOA dues. So those do add up. And depending on where you're at in the country, like just using North Carolina, for example, in the middle of the state where I'm at in Raleigh, you might see on like a $400,000 house, your average insurance premium between $1,500 and $1,800. You go 2 hours east towards the coast, and you have to factor in wind and hail insurance, as well as maybe even flood insurance, depending on the area. And you can see those numbers sometimes double or even triple. So that can be a big impact when you're planning on budgeting how much money you need for closing. That's basically the breakdown. I know we're going to get into how to pay those costs a little bit later, but that's how everything adds up to get you to that final number to closing.
Yeah, you gave us a really thorough breakdown of what that looks like. So really got three things. If you're making a down payment, you're obviously going to have your down payment, the closing costs, which are basically the one-time cost related to getting a loan, and then some prepaid items that will be recurring costs of homeownership. I don't know about you guys, but one of the things that absolutely shocks me that I hear repeatedly from people who've talked to other lenders, someone will say, "Well, I've been pre-approved. I'm pre-approved for $475,000." Awesome. And what were the closing costs? How much did you need to have at closing? What was your interest rate? What was your payment? And a lot of the time, like not 50% of the time, but 25, 30%, I don't know. I don't know. I was just approved for $475,000. That boggles my mind. So, Jessica, I see you shaking your head. What I would love is follow up on what Mike said there. So, let's say someone comes to you. We're very early in the process. Mike went through the loan estimate, which is when we get and we're opening a loan, we're going to send that loan out. So, we're required to within 3 days. But prior to that, let's talk about the pre approval process. Jessica, how are you going through the closing costs, prepaids, cash to close? How are you prepping a borrower up front so that they know, here, great news, you're pre-approved for 475, and this means you need to be prepared to have this much money at closing?
What I usually try to do is I like to give out an initial fee worksheet, like Mike said. And on that initial fee worksheet is some estimations because you're going to have things that are specific to the property type, like your taxes, insurance, those kind of things that you can't nail down exactly, but you can estimate. Also, like Mike said, the title and escrow fees, they're going to vary based on where you actually get the house at, all of those kind of things. So I usually give a good estimation of fees. I always try to overestimate when I do my closing cost initial worksheet. So that way it's a worst case scenario for people. And when I do give them the pre-approval, then I go ahead and send a video with a line by line breakdown of like, this is what every fee is. So that way it's not a surprise when we get to the loan estimate. Like, well, you didn't tell me I had to pay property taxes at closing. Why am I paying those right now? And the other thing that varies based on what state you're in is when the property taxes are due. And that changes how much of the prepaids they're going to include in that. So it really depends. Like this month, we're collecting 8 months of taxes because our taxes are due second half in October. If they close later, it would be a different number earlier. So there's a lot of variables, but I try and make sure and give a really good estimation from the years of experience I've seen of what it's going to actually be based on what area they're looking to purchase in.
Just picking up on what you just said, if you guys are cool with it, I kind of want to flip this around and let's start with the prepaids because the prepaids are actually pretty darn easy. Prepaid interest. So it's important to remember that your mortgage payment is made in arrears. So when you make your payment on the first of the month, you're paying the interest for the prior 30 days. Now, when you close, your lender does not want a partial payment. So if you close on the 15th, you're going to have that loan for 15 days. They don't want a half payment. So at closing, you're going to pay 15 days of interest. If you close on the 10th, it's 20 days. You close on the 20th, it's 10 days. So that one's pretty easy for everyone to follow and understand that you're going to pay some prepaid interest so that you have 360 or 180 or 240 full payments on your mortgage. Mike, why don't you walk through, and then what I want to do is circle back. We're all in 3 different states, 3 different ways of handling property taxes. Walk us through the insurance. What is required on a VA loan with homeowners insurance at closing? What does a buyer have to do at closing and what is collected?
So they'll pay their first year premium, which is the amount to insure the home for the next 12 months at closing. You can pay ahead of time if you want. Some people prefer to do that. I've had people that want to do it on a credit card if the insurance company allows it because they can get points or whatever. But you have to pay that first year up. And then you're going to collect on average between 2 and 3 months at closing to go into the escrow account because of what you just said about mortgages being paid in arrears. So we'll use this month that we're in now, July. You close today, you'll pay 20 days of prepaid interest, like you said, but that premium for the insurance is going to be good from July 11th, 2023 to July 11th, 2024. But if we close in July and our first payment isn't until September, when that premium comes due again next year, you'd be short on the bill for the insurance. So that's why we're going to collect between 2 and 3 months in the escrow account for insurance. Same thing with taxes. Here in North Carolina, bills come out end of this month, early next month. It varies from county to county, but they're technically not due until the first week of January. So on top of collecting how many months we need from you, the seller will also credit back their time that they owned the property. So it does kind of wash out, but on average, you're going to be putting in between 4 and 7 months of taxes into that escrow account as well. But the insurance, you have to pay the full year up front.
So, Mike, you loan in other states besides North Carolina, correct?
I do.
The states that you're in the South, is it more common that they collect once a year, twice a year? How often are the property taxes due in most of the states that you operate in?
Mainly annually. It's a little more cut and dry here. Like there's only one tax bill. Like I'm originally from Pennsylvania. I know like my family still lives up there, and they have separate bills for townships, municipalities, etc. In North Carolina, for example, there's only one bill, except for some coastal areas, but it's normally out in into August, early September, not due till January. And that's where you normally see it around South Carolina as well.
Jessica, how about Washington? How does that look for you guys up there? How often are your taxes paid?
Washington taxes are paid twice a year. They're paid, the first half are due in April and the second half are due in October. They usually have the annual tax bill out by February 15th. They're due. There's some counties that lag behind a little bit, but usually by the end of February, you can get your whole tax bill. And then they're split in half and due half in the beginning and half at the end.
So to sort of close the loop, most states are either annually or twice annually. Those that collect them twice annually are generally smarter than California, like Washington, and they say, let's do this every 6 months. The wizards in California said, let's do it twice a year, but let's not do it every 6 months. So we got 5 months between one, 7 months between the other. So we always have to look at a chart, other than the people that are really smart and just memorize every 12 months. But like Mike said, you're looking about 4 to 7 months that they're going to collect at closing. So again, the prepaids are pretty easy because really we just have 3 things in there. You might prepay a little bit of a homeowners association if you have an HOA. There could be a partial MI payment, but there wouldn't, because that would be on a conventional loan. We wouldn't have that on a VA loan. But when we look at that, so your prepaid interest is super simple. Mike did a great explanation of what your insurance is. And depending on where you are, the property taxes can be simple or a little bit more complicated. And that's just to make sure that everything is paid through closing and you will have enough in your impound account over the first year till those renewals come in. So that is actually fairly simple, but it's oftentimes a big piece of it. I don't know about you guys, people just don't account for it. They're like, well, I don't have it down. I had some money for closing costs. And you tell them like, why are your closing costs so high? And it's like, it's not closing costs. Those are prepaid. Those are your costs of homeownership, and you are prepaying them for the first year. So
one thing real quick before we move on is when you're comparing estimates, you have to make sure that, like Jessica said, I also tend to overestimate because I'd rather plan for the worst and hope for the best and make sure that goes down. But when it comes to actual regulations and compliance, the prepaid box doesn't really have a tolerance on it at all. So I've seen companies in the past, it's not as prevalent as it used to be, where they may not put the amount of taxes and insurance that you need on there, or it's artificially low to kind of make their cash to close look better. So you got to make sure that you're accurately looking at those prepaid items, because that is important, because those numbers can change unlimited from the start to finish when you pick your insurance provider, et cetera. So they may show up with, like $500 insurance premium on a $700,000 house, which we know isn't going to be accurate.
What you said, picking up on what Jessica said initially, is really important. I think most reputable lenders, most everyone in the vetted community, the worst thing we can have happen is tell you, you need X dollars at closing, and you come in and it's X plus 2,000 or X plus 5,000. So that's why we've had those numbers, not because we want to show you an astronomical number, because we're going to say, this is kind of your worst case, and likely you're going to need less than that. I don't know about you guys, but I'll get all the time, talk to someone, well, I talked to another person, I got better numbers. I need like $2,000-$3,000 less to close. And we look through it and you're like, okay, their costs are more expensive than mine. So we can kind of go back to the loan estimate and that thought of box A. Their costs, they're charging more, yet they're telling you you're going to pay less at closing. So when we're talking about closing costs, it's important to know what the lender controls and what could be higher and lower, and then what they're disclosing. The third party stuff on a purchase is going to be what you agreed to in the contract. And we can talk about some regional differences there. Tell me what Washington's like. Tell me what the South is like. But 9 times out of 10 in the contract, we've agreed that we're going to use this escrow company, or we're going to use this title company, depending on where, this attorney. It's all dictated in there. So the only control that we as mortgage originators have is essentially in box A. You have a little bit of control in box B, possibly, but on the VA, they're dictating who the appraisal is. So there's not really a lot of wiggle room. You can look at that box A, but kind of a long way of making the point of, people want to shop. A client that I talked to yesterday, she said, hey, I'm just starting the process. I want to talk to several lenders and check in rates. I go, okay, cool. Have you talked to anyone? How far have you been in the pre-approval process? She goes, well, I haven't been pre-approved. I said, so you don't know what you qualify for or which program would be best, but you're wanting to shop rates. It's like, we're putting the cart before the horse. That's important, but we have to get to knowing what you're looking for. Now we can compare apples to apples. But what you guys are talking about, I just know that we have a lot of people in Southern California running around doing loans, and a lot of them are more comfortable having the conversation at the 11th hour that, hey, you need to come up with $2,000, versus saying up front, hey, this is your worst case scenario. So when you're shopping, you have to understand what is controllable by the lender and who is giving you the best and most accurate accounting of what you're going to look for at closing. So with that, why don't we go back and have a little bit of a discussion on, as we said, about 90% of VA borrowers are going to do zero down, especially your first time borrowers, your first time use, you have that low funding fee. Mike, what are some reasons why a buyer coming to you using VA financing might want to make a down payment?
The funding fee is the main one, because it's controlled by, if you're non-exempt, it's controlled by the down payment. And especially if you get into that subsequent use category, it can make a big difference between 0 and 5% down. It can save you a couple of percent on the funding fee. So it's almost like, all right, we'll give you 5%. We'll knock off almost 2% on the funding fee. So it works out. Other reason, I had a gentleman do this on the VA loan. They had a good chunk of change and they had a payment goal. The only challenge with paying it down is the needle doesn't move as much as you think it would. I actually did a quick calculation before we got on here. So just using like a 6.75% rate on a VA loan, every $10,000 you put down moves your monthly payment about $66. It's $66.26 to be exact. So if you do put a decent amount down, it can get you to that payment goal, but it doesn't always move the needle as much as you think it would. But those are the two main reasons, is trying to get the payment down and the funding fee. And in some cases, probably a different topic, we might be using secondary entitlement and we can't go that to the 100% mark, but that'd be another reason. But like I said, different topic.
All really good and valid reasons. The one that I would throw in there is people who are not first-time buyers. They've built up $100,000 or $200,000 of equity, and they're moving up. You say $10,000 makes $66 of difference. Well, $100,000 makes $660 of difference. It may be the difference between qualifying and not qualifying, or at least your family being comfortable with that monthly payment. So there's really good reasons for it. But again, most first-time buyers, especially first-time use, are going to do the zero down, and therefore we don't really have any piece of a down payment. We're just looking at the closing costs and the prepaids. So with that, Jessica, you want to walk us through what I was talking about there in box A of the loan estimate? What of the closing costs? Mike explained left side is really your closing cost. Box A is the top of that left side. What is in there? What could be in there? I mean, there can be nothing. You can have an empty box A and it can be full. I saw one, blew my mind about 6 months ago, that someone had an Encompass technology fee in there. They were charging the borrower $200 for their software that they had to use. So lots of things can be in there. Why don't you walk us through box A, what's typically in there, what they might expect to see, and is there a right or a wrong number of what box A should look like?
Yeah, box A is the true actual lender hard cost. So it's going to be whatever that lender is charging for that program. A lot of times you'll see an underwriting fee, a processing fee. I've seen doc prep fees. I've seen administration fees in there. There can be a whole bunch of items in there that may or may not apply to your loan depending on who you're with. So there's, I'm trying to think what else is in box A that we look at. There, a lot of those are just whatever the bank wants to charge. The other big one that's in box A is going to be your discount fee. So that's whatever your cost for that interest rate is that day. So depending on if you choose to put some additional money towards the interest rate to bring that rate down, or whether you're getting what's called a par rate where there's no cost for it. The other option is if over par pricing, where you get a credit back. And that's not in box A. It's shown at the bottom in box J, I believe. But that was going to be what's in there. Your discount fee is going to be the cost for your interest rate. And then pretty much everything else is whatever the lender chooses to charge you for.
So I'm gonna throw something out here to be slightly controversial. One of our friends and vetted VA pros here, Jimmy Hobson out in Utah. If you want to upset him, you talk about box A fees. He's adamant box A should have nothing in it. And in theory, I believe that he's right. But in practice, I don't know that it matters. And here's where I'm going to go with that. And you guys feel free to react. Let's say that Mike has a $1,000 admin fee in his box A and is charging 0 points. You have nothing. You have Jimmy's wonderful, perfect, empty 0 box A, and I have $2,500 of fees stacked up in there. And I listed every one, including my Encompass technology fee. A borrower sometimes is told, hey, box A should have nothing in it. Anything in there is just junk fees or fluff. And my point in that is I don't care what's in box A. I only want to know what the rate is and the total of box A net of, Jessica, what you talked about, that credit. So the credit is off here. So it makes it a little bit more complicated because the situation can be, I have, Mike has, Jessica has, and all of our companies have a profit level that we have to hit. You know, we're not charities. You do have to make a living. So that number encompasses where they want their profit margin to be. So some lenders, to make their rate look as awesome as possible, say, I want to be as straightforward and transparent as possible. So box A is empty. So you can know that the rate is the no cost rate and you may get a credit for it. With that, how do you guys come down to that? Mike, what are your thoughts and what do you typically do with box A?
Well, a lot depends right now on the rate environment. It's kind of challenging to get an empty box A right now. We won't go into whole margin compression, everything with our rate sheets are running together. It's not historically like if you took a higher rate, you would get that credit that Jessica's talking about. If you took a lower rate, then you get the points in box A. It really depends on a lot, one, with the borrower, and two, what kind of economic climate rate environment we're in. Like right now, it is challenging not to have anything show up in box A because investors know these are likely short-term loans. Hopefully we'll see some rate improvements real soon, and we can see a lot of these vets that closed earlier this year do an IRRRL. The other big factor is credit score. So the VA is, as we know, the most flexible loan there is. Now, if I'm helping a vet right now and his credit tier is in the 580 to 590 range, I don't have an option on my rate sheet, unfortunately, to keep box A empty because it's part of the risk factor that our lending partners use. There are going to be some discount points involved in that to try, even if I raised a rate up a little bit. That's one of the biggest factors versus someone that maybe has a 720 or a 740, you're going to see less costs. And it's just how lenders do their loan level price adjustments. And that's going to be across the board on every loan. So it's not cut and dry that you're getting a VA loan. Here's what your fee is going to be in box A, because credit score impacts it. Sometimes loan to value impacts it, meaning if you put down payment, not so much on a purchase, but on a refi, you'll see that a lot when you're shopping lenders. Because, you know, we could still go to 100% on a refi with VA, but you're going to see it most of the time a hefty fee in box A for what are those loan level price adjustments to go above 90%. So it really does vary from situation to situation. And like, I'll go back to, you know, during COVID when I don't want to upset anybody, but when VA rates were in the 2s and 3s, that's when if somebody knew was going to be in a property for an extended time Like maybe they just retired. I just got out. I'm getting civilian work. I'm staying in this house until my kids get out of high school. All right, well, let's buy down this rate to 2.25. If you're not going anywhere, that's a good investment. And if it's somebody's like, I'm probably going to PCS in 2 years. All right, well, let's not buy any part of the rate down. Let's take a lender credit because you're not going to see that return on investment. So it's not really cut and dry. That's where you have to have the conversation with your loan professional, because the lowest rate isn't always the best rate for you.
So it's a great discussion, and we actually have a question here that popped up, and it's basically along the same lines. What's the advantage of buying down rates? So don't know what the listener's question was referencing in terms of temporary buy downs, which have been popular over the last few years, sort of combat everything with the higher interest rates, or a permanent buy down. But Mike, you were just talking about permanent buy downs. So in terms of that, you had mentioned that box A might not be possible to keep it at zero if you have a 580 or a 550 credit score, because that's just not how the rate sheets stack up right now. Lenders are not paying aggressively for those. I have the flip side of it. Talked to a veteran yesterday, has an 800 credit score, and we're looking at it, and the difference there for him, 0 points, was, you had mentioned earlier, it was 675 for him, and if he paid 1 point, takes down to 6.25. Historically, what our rate sheets look like, what we expect is a point will get you down 0.25%. So right now, that's pretty much more common, where we're seeing you can get almost all the way down to 0.5% savings. So the conversation with that borrower was, okay, on a normal rate sheet, that 1 point getting you 0.25%, your break even is way out somewhere near 5 years. And what you were saying, Mike, was, how long are you going to be there? Is this a good investment? Are you likely to recoup it? When rates were at 2.25, you could make the argument, hey, I'm never getting this opportunity again, so I should just buy it down and set it and forget it. So in this situation, I said to the guy, 1 point getting you 0.5%, it was a little over 24 months, like 26 months break even. So we said, here's the question that we have to ask ourselves. What do you think is going to happen with rates over the next 26 months? Because you're not buying this house with the plan of moving, so you're going to be in the house in the next 26 months. Are you likely to do an IRRRL in the next 26 months and get that thing down where you don't want to pay it? And he looked at it and he goes, I know that I don't have a crystal ball. He says, I can't envision not being able to get this lower, and I don't want to pay the additional point, even though that break even was really, really short. So kind of going back to what Mike was saying, my answer to this, what's the advantage of buying down rates, is essentially you're prepaying the interest. The lender is not giving you anything for free. They're saying, we want a yield on this. We'll take the yield in a higher monthly payment or a lower monthly payment plus some cash at closing. So your expert, myself, Jessica, Mike, whoever you're dealing with, should be able to show you those options, give you the breakdown. Here's how much it costs you at closing. So you're trading this nice safety of this much money in the bank for this much lower in a monthly payment. Now, do you think that is worth it for that recoupment period that it's going to take for you to come out to the positive? And do you think you're going to be in that house that long? That's basically the way I walk through the permanent buy down piece of it. You guys have any other insights for the listener here of how they can look at whether it makes sense to buy the rate down or not?
The one thing that I would add is just the rate buy down isn't a set, like 1 point gets you a half, a quarter. It's each lender, it's a little bit different. And sometimes, some days we can see you can jump 0.5% or 0.5% interest rate for a small cost. Some days you see it's going to cost you 3 points in discount fee to get that same 0.5%. So it varies based on all of the different loan level price adjusters of that specific borrower. So it's something you need to compare. And then once you get that number, then make sure you run your break even point on it if it's worth buying it down. The other thing, like Mike was talking about, the lower credit scores right now, a lot of the time it's not possible to not put some money towards discount points. You have to in order to get an interest rate at all in this rate environment that we're in. So just because you see discount points in there doesn't necessarily mean that it's a rate buy down. That just may be the highest rate that they have available, and that is what fits your credit profile.
And we as originators and you as borrowers, all borrowers for the last 40 years got spoiled. It used to be, you go back to the early 80s, points were always paid on loans. It was early 90s, mid 90s, before 0 point loans became popular and became a thing. And it was because it took about 10 or 15 years to people to realize that, hey, about every 3 to 5 years, we get this nice opportunity to refinance. I don't want to pay points. And it was with the securitization and selling those loans where there was a value in them at closing. Well, that's kind of got turned on its head here the last few years. No one really knows what today's mortgages are worth. Everyone believes, but no one knows that these loans are all going to refinance in the next 1, 2, 3 years. So no one knows what they're worth. So what you may have heard as rule of thumb, what you expected 5 years ago when you bought a house, when your dad bought a house 15 years ago, you can kind of throw that all out the window for the time being, because things just don't look like what we've all become accustomed to for the last long period of time. With that, we've gone through a lot of this. Why don't we talk a little bit about the third-party fees, which for the most part, again, regional. I was doing some numbers, and I forget what state someone was in. It may have been Utah just a couple days ago, and it was like a $3,000 tax. No, it was you, Jessica. It was in Washington. I have a client in Washington wanting to buy their parents' home, and the seller was going to end up paying a big tax, and the parents were giving them a great number on the house. So they're like, "Hey, you're going to pay our closing costs." So I had kind of given them some numbers, but I go, "Hey, everything's regional. Let me go through and look it up." And for them in Snoqualmie, my goodness, he had about $5,000 of taxes he was going to pay for his parents with that. So in addition to escrow and title, what do you guys see regionally? So for us here in California, we have some cities that have passed some fun little transfer taxes and whatnot. On a state level, we don't have big, massive numbers that you need to be aware of. There are transfer taxes, but other than the local cities, they're not so bad. And that's more of a seller fee. So as a buyer, you don't need to worry too much about those things, but it's something to be aware of, I suppose, when you're going to be a seller someday. Jessica, I stole your thunder talking about Washington and those seller fees. But, do you have
Washington does have the seller pays a transfer tax customarily. That's normal. There are some contracts we see where the buyer agrees to pay the seller's costs, so they'll pay that. It's like 3.2% of the sales price that they're paying on a sales tax statewide. So it just went up again. So Washington's lovely. There are a couple counties like Island County or San Juan County up there that is they have a buyer sales tax. It's a 1% fee that they pay, and that is charged to the buyer. I'm licensed in Florida too, and Florida has some sales tax that the buyer pays. Whenever you do a transaction there, they always pay a sales tax on the buyer side, versus here where there's not generally a sales tax. I'm trying to think if there's any other, just a couple counties have the more, I don't know, luxury counties, I guess I'll call them, charge the buyers a sales tax, but not overall the whole state. It's mostly a seller cost, so it doesn't really apply to the buyers.
So for us here in California, like I said, we don't have much of that fun stuff. And Mike, I didn't give you a chance to answer. So when I ask this, you can jump in and throw that in there as well. But for us, California is an escrow state. So we generally have a third-party escrow separate from title. A lot of states, the escrow piece is settlement, and it's handled as a settlement fee by the title office. But for us in California, you're going to have an escrow fee, and that's paid to the third party that basically makes sure everyone gets what they've agreed to in the contract in terms of timelines, fee breakdown, all that stuff. They handle the accounting. The title side, for us in California, they're basically issuing the title insurance to make sure you're getting free and clear title to the property with no clouds to the title. How does that compare, Jessica, for Washington? Is it pretty similar? Are you using escrow, or does some of that fall onto the title piece?
We have escrow here, so I believe we're called an escrow state, but the escrow office is usually part of the title company. So First American Title does First American Escrow. The only other thing with that is there's sometimes fees associated with that, like a manufactured home will have manufactured home processing for the title elimination and those kind of things. So that's an additional fee that escrow will charge in order to process those documents for you on your behalf. But it is an escrow settlement fee that they pay here too.
And how does that compare for you, Mike, throughout the South?
Ooh, we're an attorney state. I'll just upset you guys. So we're 90
Uh,
bucks to
no, educate us. I hear it and I go, that doesn't sound fun, but tell me about
no,
it.
it's actually it's not bad being an attorney state, but for like recording, for example, we're flat at 26 to record the deed, 64 to record the mortgage. So it's 90 bucks to record. Our transfer taxes are basically 2 basis points. So on a $500,000 home, it's $1,000. And the majority of the time in North Carolina, the seller pays those. It's traditionally the seller pays it. It's how the North Carolina contract's written. So really the only time that it's passed along to the buyer is if you're working with a national builder because they have a different contract. But in regards to an attorney state, so we still have title insurance and everything like that. The buyer can still legally pick the title company they want to work with. I've only had one person do that in my 10-year career because they had ownership in a title company. So they wanted to send it back to their title company. But most of the time, you just have your title insurance in box C. And most of the time, our attorneys just lump all their services from start to finish into one fee. And it ranges normally on average $975 to about $1,150. And that covers everything they do from start to finish. So our box Cs are really clean compared to other states. But yeah, the attorney handles all the recording, disbursement of funds, title search, basically everything signing. So it does make it easier because it's kind of like a one-stop shop, but it is a lot more cost effective in North Carolina from a tax and title perspective.
Am I understanding correctly that you don't have an escrow or settlement portion that is included in the attorney's fee?
Yeah, that's normally wrapped in there. It depends. You'll occasionally see if it's more like a national company, they'll break it out to like maybe a $500 settlement fee, $350 title search fee, this doc prep, etc. But most of the local attorneys that we work with just lump it all into that, $1,000 to $1,100 fee. Covers basically.
Yeah, you'll find that here with escrow companies too. Some of them will give you a lump sum fee where they cover everything that they do. And then some of them will nickel and dime out all of their fees, their email fee, their doc prep fee, all of that. You end up with a list this long of fees that they're charging depending on what company you use.
It's easier because most of the time the real estate agent will recommend somebody, or if the buyer knows somebody, they'll do it. But it's a lot easier shopping tool that we found in our area is that here it is all in. Joe Smith charges $1,100. Joe Davis down the street charges $1,050. Who you want to work with?
Life would be easier if everyone would do that. And it kind of goes back to that discussion of box A. I don't care what the number is in box A, but if you want to charge $2,200 in box A, charge one $2,200 fee. And we don't need 6 fees and going, what's that? What's that? What's that? It really is a fee that covers the cost of business, doing business for the lender. That's their profit margin including what any points or what they're making off of the interest rate. And same thing for escrow. The one that blows me away, we see this probably 1 out of 10 in Southern California, is we'll see an escrow processing fee. And they said, I'm kind of confused. Your job is literally processing. And why are you charging an escrow fee and a processing fee? And I'm sure there's a settlement agent and escrow officer out there somewhere that is cursing my name saying, you don't understand, you are wrong. But I'm like, that's kind of your job. That is the thing you are doing. But at the end of the day, none of these things matter other than looking at the total amount. What are you paying, and is it a fair number? And hopefully for those of you watching, the biggest and best thing that you should be taking with this, the whole concept of vetted VA is vetted pros that are going to get you honest and accurate information and advise you and not sell you something. And what you probably can see here, we're all operating in different parts of the country. This stuff is complex. It's not rocket science, but there's a lot of moving parts here. And if you don't study it, know it, and have an interest in quoting these things accurately to your clients so that they know, what's my payment going to be? How much cash do I have to have? What are the closing costs? It's easy to either intentionally or unintentionally, out of ignorance, give wrong numbers and make for some heartache for a borrower, especially a first-time borrower at closing. Before we move on to some of the different ways that we can cover cash to close, is there anything you guys think that we haven't gone through yet that would help someone watching?
The only other fee that you should see on every loan estimate with VA, except for maybe new construction, is your if you're in a area that requires the WDIR, the termite inspection. That needs to be disclosed up front if you're in one of those states, but that is a shoppable service, but it needs to be disclosed up front because, yeah, well, it might only be 150, 200 bucks, you know, leaving off stuff like that adds up quickly.
Yeah, 100 here, 100 there. You're talking real money real
Yeah.
quick.
Yeah.
And a thing, you know, we didn't talk about it, but if you are not funding fee exempt, your funding fee is going to show up on here. It's not going to impact your cash to close, but it technically is a closing cost. You are paying it. It is getting financed into the loan, and you will see that as a line item on your loan estimate. Again, it's important that you're aware of it and know what it is, but it doesn't impact your cash to close. So it takes a backseat to some of these other fees. And also, other than like we talked about earlier, making a bigger down payment, there's not a lot you can do. It is what it is, and it's going to be there the same from every lender. So we actually have another question here. And for any of you watching at home, again, our main purpose here is to answer you guys' questions. So while we're talking and going through our topic, feel free to ask any question you want, mortgage or real estate related. But we have in here, how does the real estate agent make their commission? Are they paid by the seller or the buyer? So this is pretty consistent across all 50 states. Jessica, you want to walk us through the way agents get paid and whether that's something that our buyers need to be aware of at closing?
Yeah, the commissions are usually set up once the seller lists it with their agent. They'll determine what, in Washington, I think it's nationwide, what the amount they're willing to offer for the buyer's agent and for the selling agent. So they will set that up. It's listed right on the listing. When the agents look at it, they know what the commission level that's being priced at. The VA actually does not allow buyers to pay real estate agents. It's one of those non-allowable fees. So you as a VA buyer should never be paying your real estate agent any commissions, any fees, anything like that. It all is paid by the sellers.
And even absent a VA loan where it's not even possible, that's pretty rare. Like the only time that I see it is like when investors are buying a property and there's a distressed property and they go and say, hey, I'm offering you net here. You're going to walk out the door with $300,000. I will pay all fees, including realtor fees, that type of stuff. So it's pretty rare that a buyer agrees to pay it, but there are instances where it will come up, but it wouldn't happen for you on a VA loan. So great question there. With that, why don't we wrap up here by going through what are my options for coming up with those funds? I mean, like the obvious and simple one, if you've saved up $10, $15, $20,000, you can obviously pay your own closing costs, whether that's in an investment account, checking, savings, money market fund, you borrow it from your 401k, your own funds are always going to be acceptable. But to each of you, you have a buyer come to you and say, I want to buy a house. I have enough income to qualify. I'm VA eligible. I don't need any money down, but I've got $500 to my name. Mike, what are some of the options for those folks to get their costs covered and get into the property with little to no money?
Yeah, we can normally find lender credits like we were talking about earlier. It's a little more challenging to do it in this market, but lender credits is definitely one of them. Acceptable gift funds are an option as well. And then it depends on really what market you're in, what kind of demand there is, but you can always, you know, of course, consult your real estate agent. If there's room in the sales price where it'll still appraise, you can always either off, if you think you can get the home cheaper, say it's 300 grand and we think we can get it for 290, you can offer 300 grand and say, I want you guys to pay $10,000 in my closing costs. Or if the house will appraise and you're good with it and your agent thinks it's a smart move, you can take that same property and say, we'll give you 310, but we want $10,000 in seller paid closing costs. And those funds get applied directly to the bottom line. It can cover everything but any type of down payment you have to do, or if there is a gap in the appraisal, it can't cover that. But every other number on that loan estimate or closing disclosure can be covered there. And it's not real often, but I've seen in the past when we combine lender credits with a large chunk of seller paid closing costs, we actually paid the VA funding fee up front. The only challenge with that is you have to pay all or none. You can't say, all right, my funding fee's 10 grand here, VA, I'll give you 5, you finance 5. It's all or none, but that's something that you definitely can do. One big thing that you do have to keep in mind when you are looking at the house and cash to close, you are going to have some deposits. Like in North Carolina, there's traditionally two deposits, a non-refundable one called due diligence, and then a second one that kicks in after that due diligence time frame's up called earnest money deposit. We don't see them a lot on VA because of the escape clause. The due diligence money is always at risk, but the earnest money they can get back if the home doesn't appraise. But you're going to have some of those funds up front to give to Mr. and Mrs. Seller. Say, here's $3,500. Take your property off the market. I'm going to do my inspections. I'm going to get my loan approval. I'm going to get my appraisal. So you do have to have those funds up front. But one common misconception I see with a lot of first-time buyers is, all right, I'm putting $3,500 down. It's going to reduce the sales price by $3,500. That money actually goes towards your closing costs and prepaid items. So just using round numbers, if you need $5,000 to close and you have $3,500 in deposits, that gets applied and you only need $1,500 at closing. So all the money you put in does go towards that bottom line number on the VA loan.
And that's, I mean, you guys, I'm sure you see this out in the vetted VA forums, just like I do. People all the time saying, they're asking me for a deposit. I don't have to make a down payment. Why are they asking me for a deposit? And really the simple answer is no one's going to take their home off the market without you making a good faith deposit showing that you have some commitment to this process. So you can absolutely get in with none of your own money. You can get that deposit back at closing, but it's pretty rare that a seller is going to say, yeah, we'll accept your contract and you don't need to make a deposit and we'll tie my property up for 30 to 45 days and then we'll find out if you get to close. So second only to that question, I would say the number one misconception or thing that we get people answering, members of the vetted VA forums will jump in and answer this question and insist that they have been able to finance their closing costs. So Jessica, we're going to tee this up and we're going to let you have the tastiest answer of the night. Is it possible with your VA loan to roll your closing costs into your purchase?
No, you cannot roll them into your purchase just straightforward like that. The only fee that can get financed above the 100% loan to value is going to be your funding fee. Any other closing costs have to be paid. The most common way this is done is like what Mike said, where, hey, I need $10,000 in closing costs. The property appraises. What you do is you ask the seller to pay them on your behalf by increasing your sales price by $10,000 or offering and asking them to pay it without increasing the sales price. So effectively the seller is paying them for you, but you're rolling them into your loan amount because you increased the sales price of the property to cover those. It cannot just be straight across. I offered $300,000. I have $10,000 in closing costs. I'm going to roll them in and make my loan amount $310,000. It will not work that way. It's 100% loan to value of the purchase price or the appraised value, whichever is lower.
And you guys watching may think we're kidding, but literally multiple times every week this comes up, and there are people who adamantly insist that every time they've used their VA benefit, they have rolled their closing costs into their purchase. And it triggers us poor vetted VA pros because it has never once happened, but we have lots of people that insist it's not possible other than the property appraising at the sale price and the seller being willing to credit that to you. So you can absolutely get in with $0 out of pocket, zero down payment. You can get seller credit, lender credit, agent credit, any number of credits there that can get you in without having any of your own funds, but you can't add it on top of the purchase price, as Jessica said. So I think we have done a pretty good job of going all the way through this topic every week. I always like to, as we close out here. So again, anyone watching, if you have a question, throw a question up. We're going to be here for a couple more minutes. But I always like to go around the horn, get last thoughts on tonight's topic or anything that you would like buyers in the current market to know. So Mike, why don't you kick us off and then we'll wrap it up with Jessica.
Gotcha. So since we're talking about funds to close, if your loan officer doesn't ask where your funds to close are, tell them, because you can't just tell us we have $25,000 to close. If it's in a safe in your basement, we can't use it. We have to source all the funds. So having the funds to close is one thing. Us knowing exactly where they come from is another thing. I will close on that.
And that can't be understated. I wouldn't say it's a good point. I say it's a great point. And again, I don't blame buyers, but our buyers know I've got the money. Cool, I've got the money, but they don't always understand how important it is that we have it sourced and seasoned. Where is it? How did it get there? Maybe you had $25,000 in the basement last month and now it's in the bank. Still going to be a problem for us. So it is important. We can work through anything. Let me ask you guys this on that topic. Have either of you ever had a problem funds wise where the money existed that you couldn't make it okay? I've done this for 27 years. I've never had one. We've had to jump through some hoops to make it okay. But I'm just wanting to say for those watching at home, don't be hesitant to tell us what the truth of the matter is. We will find a way to get it okay. Either of you ever had a situation where you had money that just at the end of the day could not one way or the other be used?
I've never had one that couldn't be used. I had one that was a gift from a estate from a grandma, and it took us months to get all the appropriate documentation that we needed for it. Because yes, we had a copy of the check that was from the deceased grandma, but getting the proof that they were supposed to get those funds and the actual source of it took a lot longer. But I can't think of one off the top of my head that I've ever had that we couldn't use them when it came down to it. It may have taken a lot longer than it should have, but we can use them.
I would say the same. We've had, I can tell you stories of jumping through many hoops, but we've always got it done. So I don't think it'll ever be a dead end for you, but definitely, like Mike said, let your loan officer know as early as possible so you can start coming up with plans for that. With that, Jessica, what are your pearls of wisdom for our viewers tonight? Anything on closing costs or just anything in general?
I just think the one thing that we didn't touch too much on is depending on your property type, you may have some different fees. Like manufactured homes are very common up here in the state. And with that, you're going to have extra fees, engineering to make sure the home's put down properly. So just make sure that when you're running numbers with your loan officer and you're not sure what type of a property and you're thinking that maybe you buy a manufactured home, ask them, because there's also loan level price adjusters for that type of property, along with engineering, maybe some title elimination, extra title work has to be done. So just tell them, hey, I might look at a manufactured home. Can you give me a fee sheet for that too? So just be full disclosure with your loan officer. Usually we're really willing to work with you and go through all kinds of options for you. But if you don't tell us and we approved you for a single family and then you go out there with getting a manufactured home, you get a new fee sheet and it's 100% different than what you thought, then you kind of a shock factor. So just full disclosure with your loan officer is always the best course of action.
I've got nothing to add. I'm going to co-sign both of you guys saying just disclose. We can work through almost anything. Lay all your cards on the table and we'll figure out how to play the hand the best for you. So appreciate everyone showing up here, watching, listening, following along. Hopefully this is helpful in terms of the VA loan. It's a little bit unique relative to others, and there can be some misconceptions about possibly not needing the money at all or how you can get the money. We've got lots of options. So get a good team together and they will walk you through it. So Mike, Jessica, appreciate you guys being here and sharing your wisdom and knowledge tonight. We will be back next week, and I don't know exactly what we're talking about, but it's now a word from your agents. So instead of loan officers here talking boring stuff about numbers, we're going to get some vetted realtors in to give us all the knowledge and education of what you as a buyer and possibly even a VA seller need to know from that end. So join us again next Tuesday. Again, thanks to both of you, and everyone have a great night.
Thank you.